We've had a massive recovery in the S&P 500. We're like a 0.5% off of all-time high or 52-week high, and it's been absolutely stunning. And I'm gonna do it again. I'm gonna give you my opinion on the market, on the economy, on the S&P 500. But I'm not only gonna give you my opinion, but I'm also gonna give you ideas, trade ideas, or what I believe is the best buying opportunity that no one's talking about. It's a very contrarian investment, a very contrarian bet. Is gonna shock, is gonna surprise a lot of you. A lot of you will disagree with me, but I always tell you guys, stocks bottom when no one is expecting them to, and all that stuff I do in my own portfolio. I don't only share stuff with you guys here to get views. What I tell you is what I'm trying to do in my portfolio. I bet on that stuff. Just like when I told you I was all in outside the Big Seven like a month and a half ago, and I was. And I told you I was buying the dip on the big tech, and that was on August 5th. And I was buying the dip on big tech. That's why I'm up pretty close to 53%. If I chickened out and I sold at the bottom because I was scared and I did not believe the stuff I was telling you guys, I would still be down. I'm not saying these things to claim that I was right, but I'm just trying to tell you that I actually bet on this stuff and I give you ideas so you could also do that stuff, not just talk about it to get views and all these things. So I really hope you understand that. I hope you understand the difference. And I'm going to start by talking about what I believe is the consensus view on the market, on the S&P 500, on most stocks, and then I'm going to talk about my own contrarian view, and then I'm going to discuss what I believe, I believe the market will perform in the future, and I'm going to tell you what I believe is the best buying opportunity that no one's talking about. And I hope you enjoy it. Now, if you look at this job report, which got revised around 818,000 jobs. It was overstated. Over 68,000 jobs per month. The largest negative revision since the GFC, global financial crisis. It's very, very bad. So all those amazing jobs and the strong job markets that Powell was talking about, and he was hiking interest rates into them and keeping tight monetary policy, they weren't so amazing. They weren't so great. They got revised by 818,000, almost a million jobs. So things have been much worse than they were, and we've been lied to. I mean, this is just what it is, and that's what happens in the stock market and the economy. But if you look at this chart, and I believe when most people look at this chart and you look at those red circles, you see that unemployment is starting to spike up. And as unemployment is starting to spike up, I believe most investors believe that this means we're going to have a recession, which means we're going to have a stock market crash. And they reaffirm this thesis by looking at the 10-year minus the 2-year, which is the most popular yield curve out of all the yield curves. We have like 6 or 7 of them. But the most popular one is the 10-year minus the 2-year. And it's about to turn positive. It hasn't turned positive yet, but a lot of people are saying unemployment is spiking up. You have all that stuff that's happening. And once it turns positive, we start going up. We're going to have a recession and we're going to have a massive, massive stock market crash. So you should get out of stocks right now. And this is a bear market rally. And you have to have a lot of cash and be fearful because everyone is greedy and everyone is bullish and all these things. And this is a consensus view. All right. But what I do here on this channel is I always bet on what I believe is the consensus view. And that's what I told you guys in this video when I was telling you about, how the stock market actually works. And I told you that stocks don't crash when everyone is expecting them to. This is how we bottomed on August 5th, because everyone was expecting a crash. And it just didn't happen. When everyone is expecting something, the opposite tends to happen. The unexpected tends to happen. The obvious gets discounted, and the unexpected tends to happen. And what I try to do is I try to bet on something that's not so obvious. This chart and this chart to me are extremely obvious. And for me personally, I would be willing to bet on the opposite, on something that's unexpected. Something that's unexpected for me is, what if the recession has already happened? What if the recession has already started in 2024? What if we've been in a recession since January of 2024? If you look at this job report, it's been bad, the worst since GFC. It got revised. So unemployment has already started to spike up way before now. It's maybe started January, February. So what I think about it is, what if the recession has already started? What if we're halfway through this recession? And what if all the retail stocks were leading indicators telling us that we were already in a recession? And what if those retail stocks have priced it in and they recently started to move up with Buffett buying Occidental and many popular investors buying Nike and buying Starbucks and even Lululemon? All these stocks were down. What if these stocks were telling us that we were in a recession and maybe we're halfway through this recession, and these stocks tend to bottom before the recession is over? I always tell you guys, stocks bottom on bad news when no one's expecting them to. But what if this was actually the truth? What if that happened? What if the market bottomed on a 60 plus VIX, which normally we bottom above 40? We bottomed on 65 VIX. And what if we're going much higher from here and this recession has already played out? I don't think a lot of people are saying that. And I know it sounds crazy, but that's how it's supposed to sound if you're looking for a contrarian thesis. Because if you look at this chart and look at this chart, there's no way that the consensus view is that the recession has already happened or we're halfway through a recession. I don't think so. But if you look at the leading indicators, through what I believe is the leading indicator, which is retail stocks, they've been struggling discretionary. They recently started to recover because they priced in enough bad news. And maybe Starbucks and Nike and these stocks are going much, much, much higher from here. And the recession halfway through has most likely already played out. That's a very contrarian view. But I'm going to go through the consensus view and tell you my opinion on it, on if it actually happens. Because I'm seeing so many different videos and so many different pictures around us having a flat decade, meaning stocks going nowhere for 10 years or 15 years, like what happened in Japan and all these things. And we always have those contents every time we have like a massive rally in the S&P. We have people saying stocks are going to be flat for 10 years, or we're going to have a GFC. And I believe, I'm not going to say this time is different, but I believe investors are comparing stuff to the GFC or pre-GFC. And we currently have a totally different system that a lot of investors aren't really taking into consideration. Okay, now let's talk about the consensus thesis, meaning that we're going to have a recession and all these things, because Powell did indicate, he said the time has come for policy to adjust, which what I believe we're going to have maybe a 25 basis point, I should say, rate cut in the next meeting. Now, if this happened, a lot of people believe this is when the crash and the recession begins. And maybe this is true. But if we look at the Dow stocks, I mean, they're barely up. So Dow stocks have been flat since like 2020. They're barely up 6% from like early 2024. So these stocks aren't up so much. Yes, they're a little bit up lately, but they're not up that much. And if we do have lower interest rates, this is bullish for a lot of those stocks. A lot of those stocks have been rallying whenever we had news of lower interest rates, because a lot of them have very bad balance sheets and they can refinance their debt at lower prices. A lot of the Dow stocks, that's why the Big Seven rallied. The Dow stocks, they were struggling because the Big Seven had good balance sheets. That's good for high interest rates. Now interest rates are coming down. This could be bullish for many of the Dow stocks because they have bad balance sheets and they can actually refinance their debt, and it's going to be a game changer for a lot of the Dow stocks. So lower interest rates isn't really so bad for the Dow stocks. For the Big Seven, yes, we could have a rotation out of them into the dividend stocks, which I talked about, and it's already actually playing out. But even for the Big Seven, let's say we're going to have some kind of a earnings recession for big tech, which we haven't had yet. They had good earnings, struggled a little bit last quarter or this quarter, but it wasn't too bad. It's still pretty strong. And let's assume that happens and these stocks go down. These stocks are better positioned than ever to do buybacks. Like Google still has $100 billion in cash. Amazon has $89 billion. Microsoft $75 billion. Apple 61, Meta 58, and Nvidia 31. And a lot of you told me, yeah, but this is not net debt. You have to take it net cash. You have to take out the debt. But a lot of these stocks, I mean, like they don't need the cash to pay off the debt. I mean, they have robust free cash so they could pay off the debt with, they could refinance the debt. So last thing I'm worried about is the debt of Amazon. I mean, that's the truth, guys. Like if you're valuing such stocks, I won't really worry much about the debt. But they do have the liquidity for them to do massive buybacks if we do have a recession and if we do have some kind of a multiple contraction, which now if you look at the multiple, and it's a little bit delayed because this is August 16, and this is the mega cap 8s by Ordini, and they add Netflix to them. They're trading around 29 times earnings. 29 times earnings might seem like a lot, but if you look at it on a historical average, especially taking into consideration the amazing balance sheets that they have, much higher margins, just better moats in general, better companies in general. Looking at a historical basis, you cannot say that we're like in a dot-com bubble. I mean, we're not trading where we were like 38 or 39 times. 29 times, Amazon is still growing 50%, 100% net income. Nvidia is still doing very well. I'm not sure how long it's gonna last. Microsoft's still an amazing company doing very well. Google is still growing like 34% EPS and 15, 16% next year. So I'm not saying massive bubbles relative to the balance sheets, relative to the margins, and relative to the growth. So even a recession for big tech could be bad, but they are better positioned than ever to do so. Now, let's assume in this recession, we're going to have something bad happen, a liquidity event, people say, a credit event, a bank is going to fail, or something like, what happened with the carry trade, which I believe has mostly played out. And if we have something bad happens, then what's going to happen then? And I believe a lot of investors aren't taking into consideration, that just how the Fed actually operates, and especially Jerome Powell. I mean, Jerome Powell, a lot of you guys believe that he's like a hawk or something. He's the biggest love I've ever seen. I mean, look what happened with SVB. As soon as SVB happened, people were saying that we have high inflation, which back then was 6.5%, and the Fed cannot do anything. Even with 6.5% inflation, the Fed still expanded the balance sheet by like, I believe, $600 or $700 billion overnight to save the system, inject liquidity, and stocks rallied like never before. And I know that because I bought the dip on CrowdStrike and a lot of different stocks back then. So even when we had 6.5% inflation and we had something like SVB happen, the Fed came in and pumped in liquidity. When we had the 2018 event happen, which was reverse repo and stocks went down a little bit, 2019, the Fed started expanding balance sheet and they started cutting interest rate. So even when those little things happened, with 6.5% inflation, the Fed came in and injected so much liquidity. Now, what do you believe the Fed's going to do if we have 2 and 3% inflation? I mean, do you really believe they're going to let banks fail? Do you really believe they're going to let a credit event happen without doing anything? I mean, the last thing these guys want is for them to have a bad recession or something bad happen on their watch. So they're going to do whatever it takes to push it off to the next guy. And this is how it's been since 2008. And this is what a lot of people aren't really paying attention to, is that the market has forever changed since 2008. The market has been mostly correlated to the Fed's balance sheet, and the QE mainly started in the financial crisis. We did have a lot of that stuff before that, but it mainly became in a major way, in my opinion, after 2008. And since then, when the balance sheet expands, liquidity expands, stocks go up, it stays flat, stocks stay flat, it goes down, stocks struggle, they stayed flat for 3 years, from 2017 to like early 2019 when the balance sheet was going down, and we had the 2018 crash, which I was involved in back then, and I lost some money and learned a lot of stuff. The balance sheet expanded, we rallied out of COVID lockdowns in March when no one was expecting to, it kept expanding, we kept going up, it started declining, we went down. So that's what I'm trying to tell you guys. That a lot of people are saying we're going to have a flat decade. That means you're betting on the Fed's balance sheet never expanding again. You're betting on interest rates staying 5% forever. When Powell himself has said that the neutral rate is 2 to 2.5%, and you have them, any little thing that happens, they just jump in to save the economy. And imagine what they're going to do with 2 and 2.5% inflation, or 3%, which is what we have right now. You have something else, which is not the best chart. I can put up a better picture. And this is the household allocation to stocks. 57% of households in the United States are allocated to stocks. This is pretty close to a record high. And I believe the tolerance for pain and moral hazard and all these things is way less than it used to be before. So this is something you have to keep in mind. Even though you wish we could have a crash, you could buy the dip. Even though you wish, you believe that this is not sustainable. And I believe the same thing. But we have to be reasonable. And in my opinion, just take everything into consideration and try to think how these people think in the Federal Reserve. And they don't want nothing happening. They're going to do whatever it takes to push it off to the next guy. And that's what I believe will happen. Now, if you look at what I believe is telling me that this recession could have already played out, or we could be halfway in it and it's getting close to being over, is if you look at Starbucks. Starbucks is up 23% over the last month. Starbucks hasn't reported better earnings. But I did tell you guys, stocks bottom on bad news. When the stock prices in enough bad news, and just things could get any worse. Same thing with Nike. Nike is up 14.5% over the last month. These are stocks that were leading indicators that, in my opinion, were telling us that the recession was already here. It had been playing out, and they looked past it and they're going up. Maybe this is a dead cat bounce, they're going back to 52-week lows. Maybe. But again, what I personally believe, my feeling is that this is what has actually happened. The job report exposed how bad the economy was. Maybe we were already in a recession, and always the government doesn't categorize it as a recession until a few years later. It's not like they do it in the same years. They say, oh, we were in a recession. You could have argued 2022 we were in a recession, but it's still not categorized as a recession. We had 2 consecutive GDP, we had a lot of things, and people are still saying it was a recession, and I believe it was. And maybe it's just the same thing over here. Now, when I look at what happened with retail stocks, I look at other stocks that could follow along. I look at crude oil. Crude oil has also been forgotten about. It went from $91 to $74 on recession fears. And yes, crude oil used to trade much, much higher. But you have to put in inflation in your numbers. So what I believe used to be a normal $60, $65 oil, which was normally a good time to be buying oil, could be now $70 to $75. And it's already down from 91 to 74, in my opinion, mainly based on recession fears and maybe expectations of more supply in the future. But I think it's mainly recession fears. Now, if the market starts believing and following price action on Nike and Starbucks that the recession could have played out, which is still now a contrarian bet, what I'm talking about. It's not a consensus bet. That's why oil is where it's trading at. That could be offering an amazing opportunity in stocks like Chevron. Chevron, again, it was loved by the market. ExxonMobil, Shell, a lot of those kind of stocks, or Phillips and many others, they were loved by the market, but they've been forgotten about recently. And because of the recession fears, again, because most investors believe we're going to have a recession, so oil is going to crash. But maybe oil has been pricing it in from 91 to 74 if you adjust that stuff to inflation. So Chevron and a lot of other stocks are looking very, very interesting. I personally did buy an oil stock in my portfolio. Something else that I'm looking at, which no one is paying attention to, and it's mainly the casino stocks, gambling stocks, resorts, a lot of leisure and all these things. Not mainly the cruise stocks, but mainly within the casino stocks, like Caesars, which Carl Icahn actually bought, MGM, Wynn Resorts, Penn National Gaming. These stocks are down 23%, 18%, 24%. A lot of them do have some kind of bad balance sheet, but they have valuable assets and many different things. And these stocks haven't been doing too bad. They did report slight declines, but it was nothing too crazy. But again, if you, like me, you believe there's a high likelihood that the recession, we're like halfway in it or might have played out. Retail stocks went down first. They're starting to go up. Maybe oil is going to follow. Maybe the casino stocks are going to follow. And I have both some casino stocks and I have some oil stock in my portfolio. And I'm betting on that stuff. And it's still a consensus, a contrarian kind of bet. And a lot of you are going to say, yeah, but you're going to laugh at me or whatever. But that's what I try to do in the market. I mean, sometimes I'm right, sometimes I'm wrong. And what I'm paying attention to is a 10-year minus 3 months. And this is the only yield curve that's been right 100% of the time. 10-year minus 2 year has been wrong once, and I believe it was twice, but the only data I found was it was wrong once. You could ask ChatGPT or you could put it on Google, but it was right once. I'm pretty confident. Twice maybe, but I'm sure it was wrong once. But this one has never been wrong. 10-year minus 3 months has never ever been wrong, and it's still deeply inverted. It's nowhere close to turning positive. So if it does turn positive sometime soon, and none of my stuff plays out, I'm like, maybe these people are right. Maybe we're gonna have a recession, all these things. But I think we'll likely go much, much higher before we go lower. And I'm seeing a tremendous opportunity in oil and a lot of the casino stocks, gambling stocks, you could say, even retailers, even Lululemon guys are still crashing. Buffett bought Ulta Beauty, or maybe he didn't. Berkshire Hathaway bought Ulta Beauty. And this is still a cheap stock that has yet to trade at fair value. And a lot of them have bad earnings. But I told you stocks bottom on bad news. And this is my opinion again. And I told you guys what I'm doing. Maybe I'm wrong. Maybe I just lose my shirt on this thing. But I'm still doing well year to date. So I lose some gains, not of my own money. And that's how I think about it. Not financial advice. Thank you for watching. I hope you enjoyed it. If you did, please press the like button. And maybe consider subscribing. So I'll talk to you in another video.